Kia ora and welcome to Shared Lunch, brought to you by Sharesies with BusinessDesk. My name is Helen Mattison, and on the program today I'll be talking to Brad Olsen, who's the Chief Executive and Principal Economist at Infometrics. Before we get started, here's some important information.
Investing involves risk. You might lose the money you start with. We recommend talking to a licensed financial advisor. We also recommend reading product disclosure documents before deciding to invest. Everything you're about to see and hear is current at the time of recording.
Welcome, Brad.
Thanks for having me back on.
Great to have you here in the studio here in Wellington. Now, it strikes me that it's a really busy time for economists at the moment. I mean, there's a cost of living crisis. We're in the middle of electioneering. We've got an election coming up pretty soon. Inflation is really sticky. Our major trading partner, China, isn't in such a good state. And then this week, the government opened its books. I mean, when do you sleep?
After the election, I expect is probably the answer there. I mean, look, you're right. There's so much to try and keep your head around. And I think also there's so many more questions from people, not only about what's actually happening here and now. That's been a persistent question for a while, but it is a lot more of, well, gosh, what does the future actually look like? You know, what pathways are there? What does that mean for people's just everyday lives? So there is a lot going through, and to keep on top of it, yeah, you're sleeping a few less hours and you're keeping your eye on a few more news stories. So
are you looking at a desert island in the future, just maybe not getting sunburnt, but just under a palm tree, sleeping?
Coconut in hand sort of thing. I wish. Not for me at least, only because I've got two methods. I'm either pale or I burn. So I'll take a bit of time off after the election to go and have a bit of a look around how other parts of the world are going as well. So, New Zealand's important, but the team of 5 million, we pale in comparison to the team of 8 billion globally. So keen to get a little bit more international exposure on how things are going out across the rest of the world.
No rest for the wicked.
Not for me at least.
Okay, so let's jump back to New Zealand, Aotearoa, and think about the government opening their books this week. And given the forward projections that takes into account, what can you tell us?
I think the biggest one was that Treasury is expecting the economy to broadly evolve like it did back in May, and that's sort of encouraging because it says that we're moving in the right direction. Inflation is moving lower over time. It takes a while to get back there, but at least it's decelerating and moving in the right direction. We're likely to get out of recession as well, and so all of those sort of movements I guess, bolster people's views that, yes, it's not great, it's challenging, but gosh, it could be worse, and at least, maybe there is that better pathway. For the government, of course, look, they're still challenged. There's still a lot of spending that they've got to do, a lot of inflation that they've got to cope with, and I think probably the biggest takeout for me was that for the election, there's not a lot of wriggle room in terms of new spending commitments. Normally in an election, people are keen as beans to throw out as many ideas as possible. Here's a big policy, here's another one, here's a third one on top. This time around, it's a lot more restrained, I think, in terms of what political parties can offer, and that means that, everyone, the business community, consumers, everyone's going, what's in it for me? And the answer is probably not a lot.
Yeah, so if another party get in, say National is what the polls are talking to us about at the moment, that could be quite interesting if there's not a lot in the coffers to spend.
Well, and this is the difficulty. Treasury says there are significant trade-offs into the future around what you might commit to in the future. Yes, the government gives itself a lot of money each year to spend, but increasingly that money is effectively already locked away for paying the higher costs of just the current services that are being provided. We've got to continue to pay nurses more, teachers more, all those important things. So there's not a lot left over for new policies unless we're willing to, again, think about cutting old things that we're not wanting to do as much anymore, raise some revenue or bring on some more debt. But I think it also takes us into that conversation around, we are in this electoral period. Everyone is talking about what's going on. And this always seems to, I think, develop that period where businesses go, actually, do I make big investments or big decisions now, or do I hold back? And I think, again, we're hearing that a lot when we engage with businesses. They're saying, look, just trying to figure out what happens towards the end of the year. So maybe I won't make that big commitment now. I'll just hold off.
So are we predicting that they will actually spur into action after the election, or is this a gradual change we're going to see if they're holding now?
Well, I think that this is, always something that whatever a new government might look like, be it a change from the current position or a complete, shift in administration, it's very difficult to get the wheels of government moving that quickly, in a sense. COVID besides, and that really was a different set of circumstances. You've got an election on the 14th of October. It takes a bit of time until probably November before you actually get a government figured out in terms of who's doing what roles, what have you negotiated between different parties. You'll often have a bit of a mini budget coming through in December, so you have a bit of an idea about what spending happens. And then really, if you want to do any big lawmaking, that again takes probably into 2024. So I don't think there's an immediate shift from government after the election, but I think depending on how that shake-up and that what the consistency of government looks like and the composition of government looks like, businesses probably then towards the end of the year probably have a bit of a better idea of what they might be dealing with, what sort of policies are likely to come forward. That might give businesses just enough confidence to go, actually, I'm now firm enough to move in this direction or that direction.
Now let's look at the earnings season we've just had. When we think about business, it was probably better than a lot expected, given the challenges, the macroeconomic challenges, and also those here at home with the cost of living crisis and supply demands, etc. It was actually a bit mixed. There were some warnings earlier on that the dividend wouldn't be as much or the earnings weren't as high, but generally it seemed to be that they did okay. And is that because they are able to pass on those costs to consumers and their networks as such?
I think that's part of it. That pass-through has still been happening, and you've still seen those sort of increased costs to businesses rising across the board and being sort of passed on and on through the supply chain. I do wonder as well if part of it was that we'd sort of got ourselves into such an expectation that, the earnings season was going to be a bloodbath and it was going to completely suck, that because it wasn't quite that bad, it was like, oh, okay, that's all right. You still saw, I think, a lot of warnings coming through, and for a lot of businesses, sort of a more cautious approach. You look at Briscoe's, for example, and they sort of said, well, look, sales have been all right, but, gross profits are down because those costs are continuing to eat in. I wonder as well if part of that sort of more mixed message, if you will, that came through this earnings season was because a lot of it was almost, this is how things have gone recently, but we're also not too sure, does that continue in the future? Does it get worse? Maybe for some, does it get better? And finally, I think one of the biggest shifts you had is because now you're starting to get some of that recovery coming through. Yes, you had some more challenging results, that's absolutely true, but you had some quite good wins for some businesses. You look at the turnaround for Air New Zealand, for example, that was massive. And so, for all of the bad news stories, there was also, look at this sort of bumper, massive turnaround coming through. Now, that was, in a sense, always expected, given that the likes of the borders opened, but the fact that it still happened, I think, put a little bit of a gloss on what was an otherwise bit more of a dour, sour mood.
There was definitely some headwinds, though. You think of Air New Zealand, the cost of fuel, for example, that has gyrated up and down, and it's been quite a challenge for them. They didn't give a forecast, so it's not like it's all over. We've got quite a bit of uncertainty by the sounds of things for investors to digest.
Yeah, absolutely. And I think it is that difficulty around, well, what do costs look like into the future? Fuel is a key one, especially because, look, the last couple of weeks, even we've seen fuel prices start to jump higher. So, if you're a company like Air New Zealand that uses a lot of that sort of much more volatile sort of input costs, then yeah, you're a bit worried, and you're having to constantly reassess your hedging, just how much is already locked in. Again, also thinking about, there are, in a sense, quite big margins still going forward, right? You could have a big upside risk or a big downside risk. If the economy turns better, you might see that those fuel prices are a lot worse than you were expecting. Equally, if the economy turns a lot worse or interest rates continue to rise, then maybe fuel prices will go down. So, and that's the difficulty of hedging, I think, for businesses. You want to lock in as best you can, but there is such variability. I wonder as well if part of this is because some of the challenges that have come forward again have sort of been in the past, and I look at for example Fletcher Construction and some of the outlook there around, well, they've had to book more on the likes of the International Convention Centre. The challenge and the queries, I think, coming forward are still that it's an uncertain environment. I think a lot more businesses probably put forward more forthright investment strategies going forward. They can sort of see a pathway out of these doom and gloom, more challenging times. It's just whether or not investors are super keen on that and able to sort of buy that vision, given how much disruption and uncertainty still remains.
What about things like cost of capital? I know that Infometrics has done some work on that in recent times, and it does seem to be what is quite a strong, gradual upward movement. And that's quite something for a company to actually digest, isn't it?
Absolutely, and I think this is the challenge when you have a lot of these inflationary pressures. You want to be looking as a business for productivity gains and all those sorts of things. You want to be thinking about again investments, but they've become so much more expensive than you might have otherwise thought. And like you say, if you were back in 2020 and outside of a lockdown, but thinking as a business, maybe we should expand our operation and build a new factory or something to manufacture what we're doing, or again, invest in some more plant and equipment, your budget is now reduced effectively by 18%. Whatever you thought you were going to provide back then, costs have increased so much that, again, inflation right here today might not be as intense, but that cumulative increase has been so significant. So I think for a lot of businesses, there is that sort of feeling still of caution, and it's really, I think, people coming through and going, yes, there are probably better times to come, just not sure how quickly they come through, and again, how much headroom you need to be able to navigate through, because again, this is people's money. These are some difficult investments that are coming forward. You've got some sectors that are still, I think, seeming all right. A lot of others, though, again, more in that retail consumer end, where the margins are being compressed. There's that worry about, how quickly will we get out of this? Will there need to be further interest rate rises? And probably, especially for New Zealand, that feeling that maybe here domestically things might be all right or turning better, but what does that global scene look like when China is turning into a more challenging place, when the Federal Reserve still thinks they've got to increase interest rates? All of that sort of increases the caution rather than takes it away.
What about, are there any industries, and we've talked about this before on the program, that perhaps are benefiting from this uncertainty? I'd hate to say it, but maybe there are boom times for some companies.
Well, you look at some of them, especially in the latest earnings season. Mercury, for example, I think has now had 15 years of dividend growth. So, that hasn't slowed them down. So there are some areas where there's still a lot of demand. And I think also, both growing demand, you look at renewables, that's quite clear. But equally, no matter how the economy fares, in a sense, you still need energy. You still need to be able to sort of, power things. And, it almost comes back to the old joke of death and taxes. There's always need for funeral directors and all those sorts of things. So there are some, and it's generally what people refer to as those more defensive stocks, where people are going, maybe I don't want to buy as or be quite as keen or interested in some of those more retail stocks that, again, consumer preferences, consumer spending habits on discretionary stuff, the likes of communications equipment and technology hasn't been going quite so well in recent times. Tesla, for example, have had to cut prices to try and stimulate a bit more demand. But there are some areas, I think, those more defensive stocks, infrastructure, telecommunications, again, energy, where people are going, look, it might not be sort of giving you the greatest, hugest growth returns, but actually it's sort of stable, it's solid. I'm interested in trying to get that sort of stability in my life as well. One
thing I wondered, Brad, is we've got climate reporting coming in next year, 2024, around May, which is when I think about 200 NZX companies do have to start putting some numbers to those things. Is that something that you're seeing that there's a concern about, or that actually it's being factored into the bottom line, it's been factored into resourcing, and given all these other challenges, how are they doing that?
I think it is increasingly coming forward. One of my other hats, I'm a member of the Institute of Directors, and there was a good Chapter Zero conversation that's been happening about this in recent times. So I think it's encouraging that, it's not sort of all happening behind closed doors. There is more of a conversation that's coming forward. I think those bigger businesses are broadly getting ready for it. But I also wonder, once some of that reporting comes out, you might well find, I think, a few companies having a little bit of a peek at what everyone else is doing and going, how are they doing it? What could I do better? A lot more, I think, as well, of trying to get some of those baselines, trying to get some of those measurements that maybe have been important before to some businesses, to some sectors, but not as much in others. Now there is that level of standardisation. So I think it is coming forward. It's certainly being talked about a lot more, but it's also it's completely new to everyone. So I do expect there'll probably be a few teething issues.
Yeah, it'll be very interesting to see how it all unpacks. Looking ahead to interest rates, inflation still seems relatively sticky. We've obviously got an official cash rate, another Reserve Bank decision coming up early October. What's your thinking on where things are going there? Because interest rates, obviously for business, is huge in terms of, cost to borrow, servicing your debt, etc.
I mean, it's interesting. There are so many moving parts, I think, going through at the moment. On the official cash rate, they won't move in October, certainly not before an election. I mean, that would just be very... even if it wasn't political, could be seen to be, so they'll desperately try and steer clear of that. I just don't also think they've got enough information to be able to make that call yet in terms of doing anything differently. They said back in August that they're pretty happy with how the economy is developing. It's broadly developing in line with where they thought, but they also had to make a pretty strong view out to the market. Look, just because we're not increasing or expecting an increase, don't take that to think that we're going to cut anytime soon. The Reserve Bank said it's more the second half, the latter part of 2024 before they start to cut. They did sort of highlight the risk of a further increase if it did come to pass, more around November, and sort of on our figures we're looking at sort of a 20 to 40% risk of them having to do more. Again, I think the difficulty, and no one sort of said it out loud yet, but if they do have to increase interest rates further, it won't just be one final increase. If the Reserve Bank says, look guys, 525 basis points, that's not enough, but you know what, 550, that's bang on the money. I just can't see it. If they do have to increase in November, there'll be another 50, maybe 100 basis points that they need to bring in on top. But that's not the central scenario. You then look, though, at interest rates more generally, because, the OCR hasn't moved since May. A lot of others have, though. 10-year bond rates across the world, both here and overseas, have. The government in the last week has announced an extra, what will that be? $9 billion, I think, in government bonds being issued. $2 billion next year, $3 billion the year after, $4 billion the year after that. So, that's adding a lot more into the market. And in the last, must have been a month or so, you've had an extra 20 to 30 basis points increase to those longer term borrowing rates. So there's still a bit of fear and trepidation out there that maybe we're not done. What's probably most interesting is how that's playing out in the international market. So here in New Zealand, your mortgage rate has been increasing, but at the same time, it's this feeling that, our inflation's at 6%, but our Reserve Bank thinks that they're done with interest rate rises. You go over to the US, their inflation's at 3%, but their labour market's really strong, and the Federal Reserve is still going, hey, might do some more. So there is sort of a different dynamic starting to develop. We've got sticky inflation, but at least we're moving in the right direction. Other parts of the world, they're probably worried that theirs is more sticky and more persistent, and that's actually providing for a risk, I think, of more and more interest rate rises.
The R word, Brad, that has not reared its head for a while. The government books kind of indicated that we were okay there. What's your view?
I mean, from a technical point of view, we might well be out of recession at the moment. That's sort of cold comfort, I think, for a lot of households out there, because the reason that we might not have a recession, the reason that I think Treasury is expecting something like a 0.6% increase to GDP, which would push us out of recession, is partly because we've got more people. And of course, more people that have been coming into the country with high net migration, well, that adds to spending. All those people need to go out and get the essentials, and that adds to economic activity. So you might not have a technical recession continuing. For some businesses, that might mean slightly better purchases than they might have otherwise thought. But the underlying here is that sort of spending per person is still fairly weak, and that means that the fundamentals are still a little bit cooked. The risk as well, of course, and Treasury highlighted this in the preview as well, is that although having higher levels of net migration coming in is supporting employment and supporting the labour market and what have you, that increase in demand also means that net migration could well be inflationary. And so you've got this sort of awful double-edged sword of you want more people, you want more resources, but you don't want more inflation. And so you've sort of got to give a little bit on all sides if you don't want to sort of crash things and have it all coming down around your ears.
Is it fair to say, though, that this is going to be a slow burn? We're not out of the woods anytime soon. It's more of the same, more of the uncertainty.
It's a tough slog. Yep, absolutely a tough slog. And I think when we look through a lot of the forecasts, when you sort of look almost at the levels of activity, we're as an economy needing to sit on our hands for the next 12 to 18 months. That means that some sectors are going to take a much tougher hit, the likes of construction activity now we've been seeing, I think, fall over the last quarter. So again, some challenges emerging there. Interest rates are remaining high. That's hitting a number of other sectors, real estate, consumer activity and what have you. So it does sort of feel like, look, we borrowed 5 years worth of spending or so to get us through COVID.
Yeah.
The credit card bills come due. And sort of like any toddler that's had a lot of sugar, you're having to take a bit of a snooze. You've hit the decks, you're taking a little bit of a rest stop before you start to rally again. So the economy is going to feel pretty flat, I think, for the next year. Sure, we might dodge a technical recession of having those continued negative quarters, but I don't think anyone out there is under any illusions that this is all of a sudden, better because we're out of inflation. It's just that maybe it's not worse.
Let's raise the tone somewhat, Brad. It's been a little bit depressing thinking about we've got a slow burn ahead of us. So we did know it, but, you never like to really admit these things. One of the things that we've been interested in here at Sharesies is the activity of investors. And we've noticed a lot of trends, but one in July in particular, and it keeps going, is the differences between the ages and who invests in what. So we've looked at 6 of the cohorts. So we're talking Alpha, Gen Z, Millennial, I think it's Gen X, Boomer, and post-war, if you like. And it does seem to be the older you are, the more defensive, the more local you invest. And that could be for good reason. But the startling thing is that the young people are mainly looking to the US. Tech stocks, they are of that generation where Apple and the like was, at the forefront. And they tend to actually have better returns by about 3%. I was just keen to get your perspective on that.
I think part of it reflects that sort of broader focus that we've probably got now. We've got much more access to the likes of the US markets, and we're using or talking about a lot more of these products, so they're, front of mind. And I know looking through the list, you had Tesla up there quite a lot in terms of people's interest. And I feel like I sometimes talk to people and half the time they've got some previously, almost as a bit of fun, and have sort of continued to focus on it. So I think part of it highlights when things have sort of, or were mainstream at the time. You look at the likes of Generation Alpha, and although they've got less exposure than a lot of the other younger generations, the likes of US stocks, what they do probably have a greater focus on is more environmentally themed funds and similar compared to others. And that's because, again, that's what was in vogue, that was what was in focus. You look at the likes of Zoomers and Millennials, they weren't quite as focused immediately on those things. There weren't products around, environmentally focused ETFs and what have you at the time that they were getting into investing. So I feel like some of it's that people have been building up their bases over time based on what was popular at that time that they were getting involved. But yeah, you've certainly got a much greater focus on the likes of US and more of those, like say, tech stocks coming through for more recent generations. And you get sort of, the further you go back in time, the more that it becomes defensive, and often I think a lot more closer located to home. I wonder if part of that is because sort of the more you know, the more you feel confident about it for some of those older generations. And so having more New Zealand-based stocks, that's sort of, what you might have grown up doing, or you knew people that worked for the company. So you've got a little bit more attachment, perhaps, coming forward.
I think, too, it's time horizon and risk. If you're older, you're probably not going to, bet the house on some speculative AI stock. You might want a bit of that in your portfolio. We all want to diversify, but maybe it's sort of time horizons is probably a big part of it too.
Absolutely, and that's right around the weightings, right? Like, yes, everyone might have a little bit of something, but you'll be a lot more willing when you're in your 20s and 30s to be a little bit more free and loose with where you're thinking about, in terms of you can afford to take maybe a few more risks depending on your financial position, but probably most importantly, you've got that sort of view where you'll be looking in and trying a few new things there, whereas, like say, for some of those who have been holding for a lot longer that probably will need to access their money a little bit sooner, they might well be interested interested in, solid, stable levels of dividend returns or whatever it might be, not being sort of too sort of whiz kid, fancy, gizmo gadget sort of focused. Whereas as well, I think part of it is those emerging trends that come through. Again, not all of them continue. You've got a lot of sort of fads that might trade off pretty quickly. Now, a lot more people, I think, willing to think about investing into the newer, shiniest thing. Again, those older generations probably a little bit more reserved because of that time horizon and going, look, I'd like a little bit more proof in the pudding before I'm willing to commit quite as much, especially if those returns are expected to be a bit more volatile.
One thing that seems quite interesting too is Generation Alpha. I mean, we're talking kids predominantly. And obviously on Sharesies we have kids accounts, and adults quite often will invest for their children. And it does appear that they are quite happy to go for those more climate-focused stocks, as you talked about, or funds. But for themselves, their portfolios are different. So we thought that was quite an interesting observation.
I wonder if part of that is because, again, when you're sort of maybe investing for your kids or those younger people, you're sort of going, look, these sort of things will become a lot more important over time. So maybe they're not making fantastic returns right here and now, or maybe you're a little bit more unsure about them, but maybe you're surer that in the future they'll be, better performing, or sort of you're more keen to engage in them. Whereas in your own personal world, if you're going, look, maybe I'm a little bit less confident, but also looking for something a little bit more tangible right here, right now that I can see. That might explain some of it, but I feel like as well that it's shifting over time. I think you are seeing more interest as those sort of options become more available as we talk about them. But you're right, I think it's sort of, there are some that are very early adopters, both in terms of age and profile, and others who are sort of, a little bit more reluctant to sort of jump in feet first themselves at least.
And there's always those stocks that everybody loves. Tesla, for example. It doesn't matter how old you are, it tends to be often our number 2 or number 1 sometimes stock. It has a lot of trading. Whatever you think of Elon Musk, that has, universal appeal, it would appear.
And I think that's the point, right? It doesn't matter what you think of Musk because everyone's got a view. Everyone's got a view, and I wonder sort of over time what that'll mean when you have some of those more sort of personality-driven businesses.
Yeah.
And I guess, you look at Apple as another pretty big part of it and that a lot of people invest in. I feel like not everyone sort of comes up and says, gosh, that Tim Cook, geez, isn't he a interesting bloke that's doing stuff? Like, I think that's a little bit more focused on the products and what comes out. Yes, people are very focused on the Tesla cars and what have you, but I think that part of it is that sort of interest level of, gosh, this I'm almost betting the house a little bit, or betting my expectations on Musk as a person, which is why there's been that level of interest as well in Twitter becoming X, the likes of his other endeavours, in terms of his tunnelling company and the likes as well of space, and so there's a few areas where it's sort of like I feel like there's definitely an interest in the personality, but otherwise I think still a lot of people looking for that a little bit more sort of cut and dried element of what's the service, what's the item that's being put forward here, is that likely to generate a return, is there that sort of willingness for consumers or businesses to buy in, and if not, you might well find that people fall out of favour with it quite quickly.
Yeah, if you're investing for the long term, do those kinds of stocks or companies have longevity?
Well, I mean, I remember at one point, was it Rivian or Rivian?
Oh, Rivian, yeah.
It had sold like no vehicles, and it was still like one of the second largest market caps for automobile providers, which I thought was, quite a big punt that some people were taking on some of these sort of investments. So I think there's a lot of interest. There's certainly a lot of hype though as well. And so, I feel like, yes, people hold a lot of these, but you wonder how much of it is, a real proper part of their investment strategy, and how much of it is sort of lots of people all holding a bit of it because it was good at one point, but maybe it's not worth quite as much now, which means why would you liquidate your position, because it's actually not going to return you much. So I think there might be some of that sort of previous buying that might have gone on, but given in the last couple of years how the likes of GameStop and what have you went, people have got that sometimes more of a cultish leaning on some investments than perhaps a particularly strong market-driven position.
Well, Air New Zealand here is considered very much an emotional play. It doesn't necessarily mean that you love flying or that you agree with a company that, has lots of use for fossil fuel, and yet it's supremely popular.
And deeply patriotic in a sense. And I don't mean that in terms of like rah, 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 New Zealand. It's just sort of like, that's our own. And I think that does play into it. And I think you've been seeing that more and more where businesses have been playing on that and playing sort of in that space in terms of trying to have that connection with people around. This is, part of the reason you might want to invest in company ABC is because, you can see yourself in it, or you can sort of understand its mission or its purpose. And sometimes that mission or purpose being New Zealanders doing something is going to be a big part of it.
Well, Brad, I think we might have to leave it there. You've got a huge amount on before you find that desert island, and we've got an election coming up too. So we'll be seeing you around the traps, no doubt. But thanks so much for coming in and joining us on Shared Lunch. And thank you for listening in. Don't forget to leave us a rating and let us know what you'd like to hear next on the program. We've had some really good suggestions of late, so thank you. Enjoy the rest of your week.